Hopium and common sense collide. Starring the CryptoKeeper and BlockchainCrusader. Welcome to Debate Crypto. Crypto fam, it's your boy CryptoKeeper. Welcome. We've got the FOMC meeting that is getting ready to start. We're actually going to screen share on that. I got to get it set up. Guys, just as a reminder, if you're not subscribed, make sure you subscribe. We're giving away $500 December 23rd. That is in like a week or something like that. So make sure that you guys are subscribed there. Also, just as a reminder, smash the likes, right? This is a really simple thing to do, but a lot of people, forget to do it. So I appreciate all of the support here, guys. Let me put my screen share on and let's see if we've got this going yet. Let's see if we have got it going. Hey, the market, by the way, side note, the market is up. So that is a good thing. Let's see here. Bada bing, bada boom. Has it played? Let me see if it started yet.
Which will continue to provide appropriate support for the economy. Economic activity is on track to expand at a robust pace this year, reflecting progress on vaccinations and the reopening of the economy. Aggregate demand remains very strong, buoyed by fiscal and monetary policy support and the healthy financial positions of households and businesses.
He's such a crook.
The rise in COVID cases in recent weeks, along with the emergence of the Omicron variant, pose risks to the outlook. Notwithstanding the effects of the virus and supply constraints, FOMC participants continue to foresee rapid growth. As shown in our summary of economic projections, the median projection for real GDP growth stands at 5.5% this year and 4% next year. Amid improving labor market conditions and very strong demand for workers, the economy has been making rapid progress toward maximum employment. Job gains have been solid in recent months, averaging 378,000 per month over the last 3 months. The unemployment rate has declined substantially, falling 0.6 of a percentage point since our last meeting and reaching 4.2% in November. The recent improvements in labor market conditions have narrowed the differences in employment across groups, especially for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor force participation showed a welcome rise in November, but remains subdued, in part reflecting the aging of the population and retirements. In addition, some who otherwise would be seeking work report that they are out of the labor force because of factors related to the pandemic, including caregiving needs and ongoing concerns about the virus. At the same time, employers are having difficulties filling job openings, and wages are rising at their fastest pace in many years.
Oh yeah, now we want to talk about it.
How long the labor shortages will persist is unclear, particularly if additional waves of the virus occur. Looking ahead, FOMC participants project the labor market to continue to improve, with the median projection for the unemployment rate declining to 3.5% by the end of the year. Compared with the projections made in September, participants have revised their unemployment rate projections noticeably lower for this year and next. Supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to.
Side note, this guy is a freaking crook. I think you guys know this. I just want to throw out there that ultimately all of these quote unquote projections have not been projections, right? They've been just something we don't even need to worry about. We don't need to think about. We can just print. We can send people home. We can close them out. We can make them not, we can tell them, don't go to work. You need to stay home. You need to do that. Listen, I'm not even getting political, but they know the repercussions behind what ultimately shutting down our economy and printing money like there's no stop. They know. So don't be fooled. Don't be fooled. Let's get back to it.
To upward pressure on inflation. Like most forecasters, we continue to expect inflation to decline to levels closer to our 2% longer run goal by the end of next year. The median inflation projection of FOMC participants falls from 5.3% this year to 2.6% next year. This trajectory is notably higher than projected in September.
You think?
We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials, like food, housing, and transportation. We are committed to our price stability goal. We will use our tools both to support the economy and a strong labor market, and to prevent higher inflation from becoming entrenched. We will be watching carefully to see whether the economy is evolving in line with expectations. The Fed's monetary policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee reaffirmed the 0 to 1/4% target range for the federal funds rate.
Did he just say that they've committed to keeping prices stable? Is this guy, is he drunk? Do we need to give it? You know what? We need to give him a breathalyzer. We need to definitely give him a breathalyzer before he steps up here.
With inflation having exceeded 2% for some time, the committee expects it will be appropriate to maintain this target range until labor market conditions have reached levels consistent with the committee's estimates of maximum employment.
And yes, I know the Fed is a private bank. Yes, I know that.
The median projection for the appropriate level of the federal funds rate is 0.9% at the end of 2022, about a half percentage point higher than projected in September. Participants expect a gradual pace of policy firming, with the level of the federal funds rate generally near estimates of its longer-run level by the end of 2024. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. At today's meeting, the committee also decided to double the pace of reductions in its asset purchases. Beginning in mid-January, we will reduce the monthly pace of our net asset purchases by $20 billion for Treasury securities and $10 billion for agency mortgage-backed securities. If the economy evolves broadly as expected, similar reductions in the pace of net asset purchases will likely be appropriate each month, implying that increases in our securities holdings would cease by mid-March, a few months sooner than we anticipated in early November. We are phasing out our purchases more rapidly because with elevated inflation pressures and a rapidly strengthening labor market, the economy no longer needs increasing amounts of policy support. In addition, a quicker conclusion of our asset purchases will better position policy to address the full range of plausible economic outcomes. We remain prepared to adjust the pace of purchases if warranted by changes in the economic outlook. And even after our balance sheet stops expanding, our holdings of securities will continue to foster accommodative financial conditions. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to complete the recovery in employment and achieve our price stability goal. Thank you. I look forward to your questions.
Thank you, Mr. Chair. We'll go to Rachel from the Washington Post.
Thank you very much, Michelle, and thank you, Chair Powell, for taking our questions. The latest FOMC materials say that the FOMC thinks it will be appropriate to keep rates near zero until labor market conditions reach levels consistent with maximum employment, and there are also 3 rate hikes penciled in the projections for next year. In order to set up those hikes, what will maximum employment have to look like? When will you know that that threshold has been met, and how will that be communicated? Thank you.
So maximum employment, if you look at our statement of longer run goals and monetary policy strategy, maximum employment is something that we look at a broad range of indicators. And those would include, of course, things like the unemployment rate, the labor force participation rate, job openings, wages, flows in and out of the labor force and various parts of the labor force. We'd also tend to look broadly and inclusively at different demographic groups and not just at the headline and aggregate numbers. So that's a judgment for the committee to make. The committee will make a judgment that we've achieved labor market conditions consistent with maximum employment. When it makes that, it is admittedly a judgment call because it's a range of factors. Unlike inflation, where we have one number that sort of dominates, it's a broad range of things. So as I mentioned in my opening remarks, in my view, we are making rapid progress toward maximum employment. And you see that in, of course, in some of the factors that I mentioned.
Great, thank you. Steve at CNBC.
Thank you, Mr. Chairman. My question is, if it's often said that monetary policy has long and variable lags, how does continuing to buy assets now, even though it's at a slower pace, address the current inflation problem? Won't the impact of today's changes not really have any impact for 6 months or a year down the road on the current inflation problem? And aren't you actually lengthening that time by continuing to buy assets?
Yes, they're kicking the can down the road. This is a great freaking question. Let's listen. I'm sorry for cutting him off, but they keep kicking the can down the road. At some point, the can's got to get stepped on.
Impact on the inflation problem.
So on the first part of your question, which is why not stop purchasing now, I would just say this. We've learned that in dealing with balance sheet issues, we've learned that it's best to take a careful, sort of methodical approach to make adjustments. Markets can be sensitive to it, and we thought that this was a doubling of the speed. We're basically 2 meetings away now from finishing the taper, and we thought that was the appropriate way to go.
Please.
So we announced it, and
that's
what will happen.
Smash the likes for just a minute. It'd be great.
You know, the question of long variable
YouTube.
lags is an interesting one. That's Milton Friedman's famous statement, and I do think that in this world where where the global financial markets are connected together, financial conditions can change very quickly. And my own sense is that they get into financial conditions affect the economy fairly rapidly, longer than the traditional thought of, a year or 18 months, shorter than that rather. But in addition, when we communicate about what we're going to do, the markets move immediately to that. So financial conditions are changing to reflect, the forecast that we made,
Meaning he knows that they have a direct impact affecting the markets whenever they want. This is one of the things that bothers me. Just real quick, I'll keep it brief. But they know the direct impact that they have on these markets, right? And they can say all that they want, that they are doing what's best for the people. They're not. They know and have known forever what the price to pay was going to be with just unlimited money printing, right? Now we're talking about, we didn't realize it, but we were going to have to step back. We're going to have to start tapering on bond yields and this, that, and the third. Listen, you are not stupid people. You try to manipulate people because you don't think they know as much as you do. There's a lot of people that understand this really well, and they're just freaking full of it. Let's get back to it. Sorry, guys. This guy pisses me off.
But I do not think it would be appropriate, and we don't find ourselves in a situation where we might have to raise rates while we're still purchasing assets.
Okay, let's go to Colby at the FT.
Thank you, Michelle. Chair Powell, I'm curious exactly how much distance you think there should be between the end of the taper and the first interest rate increase. Back in 2014, the guidance that was given was for the Fed funds rate to remain at the target level for a considerable time after the end of the asset purchase program. Is that an approach you support now, or does the current economic situation warrant something a bit different? Thank you.
So we haven't made any decision of that nature, and so no, I wouldn't say that's our position at all. We really haven't taken a position on that. I will say that we did talk today. We had our first discussion about the balance sheet, for example, and we went through the sequence of events regarding the runoff and that
First
sort of
discussion
thing
on the balance sheet
last time. And I think people thought that was an interesting discussion. They thought that it was informative, but people pointed out that this is a significantly different economic situation that we have at the current time, and that the differences that we see now would tend to influence how we think about the balance sheet. And the same thing would be true about raising rates. I don't foresee that there would be that kind of very extended wait at this time. The economy is so much stronger. I was here at the Fed when we lifted off the last time, and the economy is so much stronger now. It's so much closer to full employment. Inflation is running well above target, and growth is well above potential. There wouldn't be the need for that kind of long delay. Having said that, we'll make this decision in coming meetings, and it's not a decision that the committee has really focused on yet.
Let's go to Nick at the Wall Street Journal.
Come on, Nick, bring the heat, bro.
Thank you. Nick Tamaros at the Wall Street Journal. Chair Powell, in March, you answered a question about maximum employment like this. You said 4% would be a nice unemployment rate to get to, but it'll take more than that to get to maximum employment. More recently, you have hinted at a possible distinction between the level of maximum employment that's achievable in the short run versus in the long run. Has your view of the level of maximum employment changed this year, and if so, how? And how close is the economy right now to your judgment of the short run level of maximum employment? Thank you.
Right. So the thing is, we're not going back to the same economy we had in February of 2020, and I think early on the sense was that's where we were headed. The post-pandemic labor market and the economy in general will be different, and the maximum level of employment that's consistent with price stability evolves over time within a business cycle and over a longer period, in part reflecting evolution of the factors that affect labor supply, including those related to the pandemic. So I would say, look, we're at 4.2% now, and the unemployment rate has been dropping very quickly. So we're already in the vicinity of 4%. The way in which the important metric that has been disappointing really has been labor force participation, of course, where we had widely thought, I had certainly thought that last fall, as unemployment insurance ran off, as vaccinations increased, as schools reopened, that we would see a significant surge, if you will, or at least a surge in labor force participation. So we've begun to see some improvement.
Oh, you mean trying to force ideas and force things into people? Maybe made them not want to go back to work for you? Man, that's crazy. You shut everything down, and then ultimately when you shut everything down, people start to recognize that they can make money on their own. People are realizing, wait a minute, I have a job, which is great, but I had to get a side hustle on because I wasn't working for so long. Now my side hustle makes more than my job. Screw that. I'm not going back. You didn't think about that, huh? Interesting. Let's hear more.
Recovery yet, and we may not have it for some time. At the same time, we have to make policy now, and inflation is well above target. This is something we need to take into account.
If I could follow up, you've talked recently about risk management, and so does that mean that the committee might feel compelled to raise interest rates before you're convinced
this is
that
important.
you've achieved the employment test in your forward guidance?
So this is not at all a decision that the committee has made, but you're really asking a question about how our framework works. And yes, there's a provision, what used to be called the balanced approach provision, that says in effect that in situations in which the pursuit of the maximum employment goal and the price stability goal are not complementary, we have to take account of the distance from the goal and the speed at which we're approaching it. And so that is in effect an off-ramp which could, in concept, be taken, and it's in our framework. It's been in our framework a long time. I've talked about it on a number of occasions. It is a provision that would enable us to, in this case, because of high inflation, move before achieving maximum employment. Now, as I said, we're making rapid progress toward maximum employment in my thinking, in my opinion, and I don't at all know that we'll have to invoke that paragraph. But just as a factual matter, that is part of our framework and has been really for a very long time.
Thank you.
Thanks. We'll go to Howard at Reuters.
Thanks, as usual. So I guess I got to ask about the elephant in the room, which is the Omicron variant.
Oh, God.
This seems to already be pushing one of your colleagues, the Bank of England, off its course. Things have evolved very fast there. Hasn't quite hit the shores of the U.S. in full force yet, but people seem to expect it to. So I'm wondering, in your feelings about this? Are you convinced that this is going to be perhaps a more infectious but less serious variant of the virus? Or are you simply confident that the U.S. economy can continue its divorce from the pandemic?
Well, I think there's a lot of uncertainty, which is why we called it out in our statement, our post-meeting statement, as a risk. We follow the same experts, and we talk privately to the same experts that everyone else does, and read the same articles in the paper and the same research. And so you mentioned the early assessment is highly transmissible, perhaps not as severe, some continuing protection from existing vaccines and also existing immunity from having had the disease. That's a first draft. We're a long way from knowing what it will turn out to be. It may well come to the United States and replace Delta as the dominant variant fairly quickly. That could easily happen.
You like how somebody that has, listen, check this out. So here's how you know who runs things, right? He literally is talking about, he has no medical background whatsoever. And he is talking about how it likely might come here. This variant likely might come here and become the dominant, right? Oh, really? What, like, where are you getting this information? Oh, wait a minute. You guys control the narrative of just about everything on planet Earth. No wonder you could figure out what's happening next. This is incredible. Thanks. Oh, it's disgusting, guys. I swear.
So people who get the new variant, it affects them much less than it tends to affect in the aggregate people who are not vaccinated. So the more people get vaccinated, the less the economic effect. Won't have an economic effect. Delta had an effect of slowing down hiring, and it actually it had an effect on global supply chains, and that sort of that hurt the process of the global supply chains getting worked out.
At least he admits that they think that it's going to be less harmful. That's good.
At this point, we don't know much. We'll know a whole lot more in 3 weeks, and we'll know more than that in 6 weeks.
But if I could follow up, you clearly are sort of from a risk standpoint comfortable putting away one of your tools pretty soon, which sort of implies that whatever Omicron brings, you're comfortable the economy can handle it without quantitative easing.
Yes. I think if you look at the state of the economy and the strength of demand, the strength of just overall demand, the strength of demand for labor, look at inflation, look at wages. I think moving forward the end of our taper by a few months is really an appropriate thing to do, and I think really Omicron doesn't really have much to do with that.
Thank you.
Let's go to Gina at the New York Times.
Hey, Chair Powell. Thanks for taking our questions. I wonder if you could talk a little bit about what prompted your recent pivot toward greater wariness around inflation.
Oh,
Sure.
Good question.
So I guess I would go.
This is a great question. I'm really interested to see what he comes up with here.
And it's been a continual process, really. Inflation really popped up right in the late spring last year, and we had a view. It was very, very widely held in the forecasting community. This would be temporary. It was quite narrow.
Oh my gosh.
To support that view that it would be temporary or transitory, as we said. Certainly, we had 5 months of declining month-on-month, monthly read inflation, but we didn't see much in the way of progress on labor supply or on other supply side issues. Then in September, I'd say after Labor Day, we started to see it started to become clear that this was both larger in its effect on inflation and more persistent. And of course, I said so on many occasions. And one of the consequences of that is that we moved the taper forward. And it's a much faster taper than had been planned. So we've been adapting. I've been saying we're adapting our.
Just real quick, guys. I know we want to keep listening to this. You don't want to be listening to me, but let me just throw something out there real quick. This is no matter whether you like to hear this or not, these are very intelligent people, okay? Like, they're not dumb, okay? You can call them idiots, you can call them stupid, you can call them whatever you want. They are not unintelligent, right? They are not stupid. They are not dumb, okay? They knew that printing trillions of dollars creates inflation, right? We have a little thing in economics called supply and demand. When all of a sudden you increase the supply absolutely to infinity and beyond, like freaking Buzz Lightyear, what do you think's going to happen? They know, they've known, and that's why people say they call it kicking the can down the road. At some point, that can's got to get run over by a passing car. Well, that point is getting closer to now, and they're trying to figure out, what are we going to do? But they've known the whole time that this was coming. Just want to be clear on that. Okay.
Turns out much faster progress in the labor market. Really, what's happening is the unemployment rate is seems to be catching up with a lot of the other readings of a tight labor market, 0.6 over one cycle. So that's really what happened. And, widely supported in the committee today. As you can see, unanimous vote. But beyond that, I think widely supported this move.
If I could just follow up quickly, you noted that the ECI was one of the things that made you nervous, but you also said earlier that you don't see signs that wages are actually factoring into inflation yet. And I guess I wonder how you think about sort of the wage picture as you're making these assessments.
Right. So what I said, you quoted me correctly. It's so far we don't see wages are not a big part of the high inflation story that we're seeing. As you look forward, let's assume that the goods economy does sort itself out and supply chains get working again, and maybe there's a rebalancing back to services and all that kinds of thing.
Hey, TikTok, if you want to come over to Debate Crypto, no spaces, Debate Crypto, we're giving away $500 December 23rd. All you got to do is be subscribed, and you can watch what we're doing on YouTube and actually get in on the chat over there as well. I'm sorry, I can only watch one chat. I'm interacting over there on YouTube. Debate Crypto.
Productivity growth that puts upward pressure on firms, and they raise prices. It would take something that was persistent and material for that to happen, and we don't see that yet. But with the kind of hot labor market readings, wages we're seeing, it's something that we're watching. And the other thing, of course, is rents, which are very important. Owner's equivalent rent and rent. That's another thing which is very economically sensitive. Unlike the things that are causing the inflation now, this is economically sensitive, and so would be expected to move up. And so as some things go down, the question is, where will we be when we come out the other side of this? And we need to keep our eyes on those things.
Thank you.
Thanks. We'll go to Chris at the AP.
Come on, Chris. Somebody bring some more.
Thank you. Well, next year you could see growth slowing, and you could see some disinflation.
It's Debate Crypto, DEBATECRYPTO, Debate Crypto, guys, on YouTube.
With inflation fading and growth slowing, how would you explain rate hikes to the public, particularly those who may still be looking for work?
Well, as you know, the SEP is not a plan. It's not something we debate, negotiate over, or really discuss in terms of what the right answer should be. People write down their assumptions, their assessment of appropriate policy based on their economic forecast. And so the median, what you're talking about, the 3 rate increases, that's the median of the committee. The median of the committee is also that growth will be 4%, and that unemployment will be 3.5% by the end of the year. So that's a really strong economy. And of course, if the economy turns out to be quite different from that, then so will the rate. No one will say, oh, we can't change our policy because we wrote something down in December. That no one's ever said that or will. It will. The actual rate decisions we make will depend on our evolving assessment of the forecast. So, for example, if the economy were to slow down significantly, then you would expect that would have an effect of slowing down rate increases. But we'd have to, we look at our 2 goals, maximum employment and price stability, and we make policy based on them, and not with respect to what we wrote down in a prior SEP.
Thank you. Let's go to Victoria Guida at Politico.
Hi, Chair Powell. I wanted to follow up on maximum employment. So, the new framework was basically designed, as I understand it, so that there was a de-emphasis on guessing where inflation would pick up because of employment. And basically, you were going to wait until you saw the whites of the eyes of inflation, and that's how you would kind of know that you reached maximum employment. So I'm wondering, you've talked a lot about the different ways that you might measure maximum employment, but from what I understand, and that's still basically the way that you know that you're there, is inflation. So is that understanding correct? And how are those signals likely to be clear right now, given that you have inflation that's caused by, these supply chain disruptions that might also lead to, inflation in wages and those sorts of things? So how do you sort of tease out the signal of maximum employment?
Okay, so let me start by saying that the inflation that we got was not at all the inflation we were looking for or talking about in the framework. It really was a completely different thing. It was to do with, strong monetary policy and fiscal stimulus into an economy that was recovering rapidly and in which there were these supply side barriers, which effectively led to, in certain parts of the economy, of what you might call a vertical supply curve. So, automobile purchases are very interest rate sensitive, and you would think demand would drive up the quantity of cars, but it can't because they don't have semiconductors. So that was a very different kind of inflation. This is not the inflation we were looking for under our framework at all. It's nothing to do with our framework, and the way we've approached it is really nothing to do with our framework. But come to maximum employment, which is really your question. How do you know? So I think you look at prices and quantities. If you want to look at maximum employment, you look at prices and quantities, and the main price you look at is wages. It's one of the things you look at, and it's. So I mentioned a number of the things. You could get to 20 if you wanted to easily, but labor force participation, the unemployment rate, different age groups of prime age labor force participation in particular gets a lot of focus. The JOLTS data get a lot of focus, and wages. That's really one of the great signals. The quits rate is another one. The quits rate is really one of the very best indicators, according to a lot of labor economists, because people quit because they feel like they can get a better job, and there's record amounts, historically high levels of that going on, suggesting again that you've got a very tight labor market. So on wages, that's the price indicator we look at to tell us, along with all the other data, whether we have labor market.
Is that why you think we've had so many people quitting their jobs, Mr. Powell? Is that really what you think? I would argue that you are being intellectually dishonest.
One of the complications is that, again, we've got to make policy in real time. So how do we think about that? If we think we can make labor, participation might move up. If let's say we knew that it would start to move up in 2 years, would we wait 2 years or when inflation is running way above target? Probably not. So you have to make an assessment that what is the level of maximum employment that is consistent with price stability in real time is one way to think about it.
Just to kind of follow up on that for a second, if you do raise interest rates next year and you're not certain whether you're at maximum employment, I mean, are you all going to point, when you raise interest rates, are you going to point to ways in which the labor market could still improve?
Yes, I mean, I absolutely. I think whether or not we say we're at conditions, labor market conditions consistent with maximum employment next year, we would all be open and I think expect over time that the level of maximum employment that's consistent with price stability would increase further over time. For example, through increasing participation. So we would certainly, we would not in any way want to foreclose the idea that the labor market can get even better. But again, with inflation as high as it is, we have to make policy in real time. We've got to make that assessment in real time.
I want to say something real quick. I love how they are pointing at inflation as if they didn't create it, right? Listen, I know that we got put into a really bad situation, and whether you're left, right, I don't care what your political view is. The reality is these upper levels of government, private entities like the Fed, like they knew what was going to happen as a result of what they're doing. But now what's happening is we get a little bit of a twist and a torque and a spin. And what is that spin? That spin says this. That spin says, oh my gosh, look at what happened, and now we have to change our plans. What do you mean? The inflation was part of your plan. It had to be. You don't have to be an economist to know that when you print trillions of dollars in half a second, right, that it's going to have a negative effect or impact on our entire world, right? But now what it looks like is that he's saying, see, look what happened. Inflation. Now we need to look at doing X, Y, and Z. No, Jerome, you knew from the start that inflation was going to cause X, Y, and Z. So let's just be clear.
Caretakers is certainly part of it, not just for children, but for older people. It has been pointed out by many that the stock market is high, people's portfolios are stronger. They may go back to being a one-income rather than a two-income family. The same thing with people's houses. People they have a mortgage, and with leverage, and the house price increases, the equity they have in their home might have doubled, and they might reach the same conclusion. So and people have savings on their balance sheet because of forced savings, because they couldn't spend on travel and things like that, and also because of government transfers. So for all of those reasons, and it's hard to know exactly the part each of them plays, we have a situation where we've had a shock to labor force participation that is not unwinding as quickly as many has expected. And people, it affects, a good part of it is voluntary. People, and this is how they want to maximize their welfare, and that's certainly their choice. In other cases, it's something that will abate very quickly if and when the pandemic gets under control. And the longer the pandemic goes on, maybe the less likely that people will come back, because they get used to their new life and they lose contact with their old jobs. That's what the evidence would say. So it's a range of things. It isn't that the economy lacks stimulus. Usually in every other expansion, it's that there aren't enough jobs and people can't find jobs, and we're stimulating demand and trying to get demand to come up. That's not the problem here. The problem is a supply side problem, which what it would take to work it out, I think it's going to be time. And the number one thing it would really be to have the pandemic get under control. That's what everyone would really like to see. What is the labor force? What is the labor market?
Another finger pointing session, right? Another finger pointing session. See, what would really fix all these problems if this would get under control? Oh, wait a minute. You ultimately could have made a lot better decisions. These upper level people, these unknown people that run the world, whether you think they exist or not, they do. And I'm not with tinfoil hat or anything. I'm just saying. And all that had to be done was some different decision making. But instead, here we are. Here we are.
This. And we actually got above the demographic trend at the end of the last expansion. So one would expect over time that labor force participation would move down, because an aging population, the older people are, the lower their participation rate is. So you would expect that the trend would be lower, and that over time participation would move down. The question of how much we can get back up closer to where we were in February of 2020, and indeed for the year or so before that, is a good one. And I mean, what we can do is try to create the conditions. There's a lot of good for society when you have a tight but stable labor market where people are coming in, they're getting in the labor force, they're getting paid well. In the labor market we had before, we had the biggest wage increases were going to people at the bottom end of the wage spectrum for the last couple of years. There were just a lot of really desirable aspects of a labor market like that. Higher participation is one of them, and we'd love to get back there. But again, ultimately, we have the tools that we have, which are essentially to stimulate demand and also to control inflation. I mean, really, it might be one of the two big threats to getting back to maximum employment is actually high inflation. Because to get back to where we were, the evidence grows that it's going to take some time. And what we need is another long expansion like the ones we've been having over the last 40 years. We've had, I think, 3 of the 4 longest in our recorded history, including the last one, which was the longest in our recorded history. That's what it would really take to get back to the kind of labor market we'd like to see. And to have that happen, we need to make sure that we maintain price stability.
Okay, let's go to Edward Lawrence at Fox.
Come on, Fox.
Thanks. Thanks, Michelle, and thanks for taking the question, Chair Powell. So I was looking at the census data there for estimate monthly changes on sales, and what you're seeing is fewer people spending at restaurants and drinking places, more people spending at grocery stores. You see electronic sales down 4.6% month over month. Also, department store sales down 5.4% month over month. How concerned, or what is your level of concern the consumer may be turning away from this economy or pulling back because of inflation, the virus, or something else? Thank you.
We see consumer expenses very strong in this quarter. I don't know, Edward, whether you're talking about more shopping online versus shopping in the store, but consumer demand is very strong. Incomes are very strong, because people are going back to work and they're getting wage increases. Admittedly, some of the wage increases is being eaten away by inflation, but nonetheless, incomes overall are going up really significantly because of increased employment, and spending has been strong. There may be something in the seasonality that this year's holiday spending may have been pulled forward, and of course there may be effects from Delta, and there might be going forward from Omicron. But fundamentally, the consumer is really healthy, and we expect personal consumption expenditures to be pretty strong in the fourth quarter.
Okay, let's go to Mike at Bloomberg.
Mr. Chairman, the median forecast for inflation in this month's or this meeting's economic projections has been revised up significantly for 2021, but barely moved for 2022 and 2023. You've said you expect inflation to fall significantly. Is that because you're going to raise interest rates, or because the virus is going to fade and the effects are going to fade? In other words, is it a question of when, not if, you raise interest rates? And does it suggest that maybe your critics are correct and you might be afraid you're behind the curve?
So actually, I'm looking at the SEP here, and the median forecasts for core and headline inflation did move up by 0.4 each. So that's a significant, in an SEP, that's a pretty significant move up. It's based on both of those things, I suppose. I do think there's a broad expectation among forecasters, including our own, that the bottlenecks will alleviate sometime over the course of this year. If you look at where blue chip forecasts are, which is the group of well-resourced large forecasting operations with a long track record, they'll show inflation coming back down significantly toward the back end of next year. I would say, though, as well, that our policy should begin to have an effect. There will be a lag, but it should begin to have an effect on that as well. That's the most likely case. I guess what the thing I would want to say, though, is we can't act as though that's a certainty, and we're not going to act as though that's a certainty. There's a real risk now, I believe, that inflation may be more persistent, and that may be putting inflation expectations under pressure, and that the risk of higher inflation becoming entrenched has increased. It's certainly increased. I don't think it's high at this moment, but I think it's increased, and I think that's part.
Let me say something real quick, okay? Check this out, guys. And this is an opinion. I might be wrong about this. Maybe someone in here is an economist and can tell me, but I believe that the best way to forecast inflation is to look at consumables, is to look at like how much is a loaf of bread? How much is a gallon of gas? How much is a gallon of milk? How much is all of the things that we buy on a daily basis, weekly basis, monthly basis? How much is that up? Because if you look at the numbers, gas is up 50%. Now I'm going to be off a little bit on these, but I think milk was up 25%. Lumber for a while was up hundreds of percent, right? That's a whole nother thing. But I own a construction business and I know all too well that side of things. I guess what I'm saying is the everyday things that we pay for right now, every single one of them is significantly higher than the numbers that they're giving us. So I feel like we are using the CPI, the Consumer Price Index, is a flawed way to look at inflation, if you ask me. It absolutely is not showing us what the reality is of how that gets passed down to us. It literally affects everyone down to my employees of my businesses, because ultimately they've got to, if they're driving to work, gas is absolutely crushing them, right? Well, if they're driving back and forth to work, maybe they got to stop and get food. Guess what? They got to pay for that. That's incredibly up. The CPI is not a good metric to go off of. It's just not.
But nonetheless, it's something we're watching. Funding risk is by and large low among financial institutions, but we do see money market funds as a vulnerability, and would applaud the SEC's action this week. Leverage among financial institutions is low in the sense that capital is high. So overall, financial stability. That's how I would make an overall characteristic, but we break it down into those pieces. In terms of the things that we're looking at, it's the things we've already talked about to some extent. It's the emergence of a new variant that could lead to significant economic. If there were to be a variant, for example, that were quite resistant to vaccines, it could have another significant effect on the economy. We don't see that. We don't have any basis for thinking that the new variant that we have is that one, but it's certainly one we're looking at. I would say, cyber risk, the risk of a successful cyber attack is, for me.
Quick question, guys. I don't want to keep butting in. Why do they keep talking about this cyber attack? Like, are they setting us up? Are we getting set up for a cyber attack? Because right before the pandemic happened, they were having meetings about what to do in a global pandemic, right? So I believe that a cyber attack is coming. Let me just say this, and we'll jump right back into it. Yesterday, right? Yesterday, when the freaking coin market cap, when Coinbase, when everything went, nutso, it had me worried for a second. I was wondering, is this happening right now? Right? Is it happening? I don't know. Just something to think about. It seems as if they are planting seeds, and when they plant seeds, it means that they're going to water. Yes, somebody said, Kareem says predictive programming. Yes. Bearded Gaming, they're priming us. Yes, absolutely. Guys, drop a 1 in the chat if you think that that this is predictive programming. I believe that it is. And TikTok, come on over to Debate Crypto on YouTube. Come check us out. We're giving away $500 December 23rd. Let's go.
With one of the very large tech networks that exist, and you could have a payment network that was immediately systemically important, close to immediately systemically important, that didn't have appropriate regulation and protections. The public relies on the government and the Fed in particular to make sure that the payment system is safe and reliable, as well as the dollar, and to provide a safe and reliable, trusted currency. So, but I do think those are longer term. In terms of the more the cryptocurrencies, that are really speculative assets, I don't see them as a financial stability concern at the moment. I do think they are risky. They're not backed by anything, and
your dollar's not
who
backed
may or may not understand what they're getting. And there's certainly developments in the markets that are worth following, which are really not in our jurisdiction, but things like the kind of leverage that's built into them and those sorts of things is certainly worth watching.
Wow.
Let's go to Nancy Marshall Genzer
Nice.
at Marketplace.
That's actually not. That's good that the way that he ordered that.
Hi, Chair Powell. Thanks for the question. Going back to inflation, is the Fed behind the curve on getting inflation under control?
So, I would say this. I actually think we are well positioned to deal with what's coming, with the range of plausible outcomes that can come. I do, and I think if you look at how we got here, I do think we've been adapting to the incoming data really all the way along, and noticing and calling out that the both the effects and the persistence of inflation, of bottlenecks, labor shortages, and things like that.
If your portfolio is pumping, smash the likes. Make sure you subscribe.
The fact that those were becoming longer and more persistent and larger, And now we're in a position where we're ending our taper within the next, by March, in 2 meetings, and we'll be in a position to raise interest rates as and when we think it's appropriate, and we will, if that, to the extent that's appropriate. At the same time, we're going to be seeing a few more months of data. I don't actually think we're out of position now. I think this was an important move for us to make. I think that the data that we got toward the end of the fall was a really strong signal that inflation is more persistent and higher, and that the risk of it remaining higher for longer has grown. And I think we're reacting to that now, and we'll continue to adapt our policy. So I wouldn't look at it that we're behind the curve. I would look at it that we're actually in position now to take the steps that we'll need to take, in a thoughtful manner to address all of the issues, including that of too high inflation.
That you created.
Let's go to Evan at Market News.
Hi, Chair Powell. Thank you. I was wondering if we should still be seeing the taper and interest rate hikes as separate. And secondly, in the last cycle, the Fed started shrinking the balance sheet when short-term interest rates were about 1 to 1.25% range. Do you think the FOMC might be able to potentially start running off assets before that this time?
Are they separate? So our interest rate, they are separate tools. So that, the asset purchases are a separate tool from interest rates. Stopping asset purchases does not remove accommodation, it just stops adding further accommodation, whereas raising interest rates starts to remove accommodation from what is a highly accommodative stance. The extent to which they'll be separated in time is something we haven't really discussed at the committee yet. We will be discussing that obviously in coming meetings. I don't think that the last cycle there was quite a long separation before interest rates. I don't think that's at all likely in this cycle. We're in a very, very different place with high inflation, strong growth, a really strong economy. That as I mentioned, the SEP medians are for 4% growth next year, 3.5% unemployment at the end of the year, and the headline inflation of 2.6% next year, core at 2.7. So this is a strong economy, one in which it's appropriate for interest rate hikes. So they're separate, I would say. Your second question was?
My second question was about runoff.
Runoff
in the last cycle.
So with the balance sheet, we did have a balance sheet discussion. It's our sort of first discussion of balance sheet issues at our meeting this week. We'll have another at the next meeting and another at the meeting after that. I suspect these are interesting issues to discuss. Didn't make any decisions today. We looked back at what happened in the last cycle, and people thought that was interesting and informative. But to one degree or another, people noted that this is just a different situation, and those differences should inform the decisions we make about the balance sheet this time. So I haven't made any decisions at all about when runoff would start, but we'll be continuing to, in relation to when either liftoff happens or the end of the taper. But those are exactly the decisions we'll be turning to in coming meetings.
Thank you. We'll go to Scott Horsley at NPR.
Thanks, Mr. Chairman. I think you said a few minutes ago that the inflation that we got during the pandemic was not the inflation that you anticipated when you crafted the framework, and you described it as a collision of a lot of monetary and fiscal stimulus with these supply side hiccups. Does that mean the stimulus was mistaken, or is the inflation just a consequence that we have to put up with because of that?
No, I'm not expressing any judgment about the stimulus in that comment.
Of course,
what I'm saying is there's a sense among some that you wanted inflation. This is what you wanted. How do you like it? And the truth is, this is not the inflation what we were talking about in the framework was inflation that comes from a tight labor market, right? So we had 3.5% unemployment for a period, and we had inflation that was just barely getting to 2%. And I think in that setting, our thinking was we can afford to wait to raise rates until we see actual inflation rather than preemptive, because no one had seen what 3.5% unemployment would look like, with high labor force participation, by the way. No one had seen what it would really look like for an extended period for decades. And we didn't know what the inflationary implications were. Turned out there was barely 2% inflation and no sense that it was gaining momentum and that kind of thing. So we incorporated that into our framework.
He doesn't believe
this is something completely different. That's a situation where you had a very, very high level of employment and low inflation. This is literally the opposite, or it has been the opposite, where we have very high inflation, and we've had it since the labor market was in terrible shape. It had nothing. So far, this inflation has really nothing to do with tightness in the labor market. It does have to do with strong demand, and strong demand was supported by the Fed. It was supported by Congress. I'm not making any judgments on Congress. It's not my job, but I will just say we're coming out of what we certainly hope will be a once in a lifetime, certainly historic, the first really global modern pandemic, which looked at the beginning like it might cause a global depression. And, so we threw a lot of support at it. And what's coming out now is really strong growth, really strong demand, high incomes and all that kind of thing. People will judge in 25 years whether we overdid it or not. But, the reality is we are where we are. And, we think our policy is the right one for the situation that we're in.
Thank you. Let's go to Brian Chung.
Hi, Chairman Powell. Wanted to ask about the bond markets. When you see the 10-year at 146 basis points, do you have any sort of concerns about an environment by which you might be hiking interest rates into? Would you prefer the curve be a little bit steeper? What are you gleaning from the bond market actions over the last 6 weeks?
So I think the short end actions are easy to understand, which is, they're basically very policy sensitive rates at the short end, and it makes sense that's reacting to changes in expectations for policy. I think a lot of things go into the long rates, and the place I would start is just look at global sovereign yields around the world. Look at JGBs, look at bunds, and they're so much lower. You can get a much higher yield on U.S. Treasuries by buying USTs rather than bonds, and you can hedge the currency risk back into yen, back into euros, and still be way ahead. So in a way, it's not surprising that there's a lot of demand for U.S. sovereigns in a world, in a risk-free world where they're yielding so much more than bonds or than JGBs. So that's a big part of it. I also think, there may be some assessment in there of what the neutral rate is or what the terminal rate is. I don't know about that, and I would just say that we write down our own estimates of the terminal rate or the neutral rate of interest. Those are highly uncertain, and we'll make policy based on what we're seeing in the economy, rather than based on what a model might say the neutral rate is. We all have the experience of the last cycle, where we all through that cycle were trying to estimate what the neutral rate was, and it turned out, I think we learned a lot from seeing what happens. We ended up cutting rates 3 times after raising them to 2.25% to 2.5%. So I'm not troubled by where the long bond is. I see that it's low. We're really focused on broader financial conditions. We're focused on maximum employment and price stability.
Thank you. For the last question, we'll go to Greg Robb.
Thank you very much. Chair Powell, I wanted to give you the opportunity to talk about something I've heard that's been discussed, that, your pivot towards a tighter policy, hawkish policy stance had something to do with the timing of your re-nomination by the president. Thank you.
Sure, I'd be happy to talk about that. So as I mentioned, we got the ECI reading just before the November meeting. We got the labor market report 2 days after the meeting, and then 1 week after that, I think on the 12th of November, we got the CPI reading. It was really the CPI reading in concert with those two. And I just came to the view over that weekend that we needed to speed up the taper, and we started working on that. That's a full 10 days or so before the president made a decision on renominating me. So honestly, it had nothing to do with that at all.
Sure.
And I just thought this is what we got to do. My colleagues were out talking about a faster taper, and that doesn't happen by accident. They were out talking about a faster taper before the president made his decision. So it's a decision that effectively was in more than in train, and to the point where people were talking about it publicly. So that's what happened, and it had absolutely nothing to do with it whatsoever. We're always going to just do what we think is the right thing, and I certainly will always just do what I think the right thing is for the economy and for the people that we serve.
Just a quick follow-up. I guess that some people are saying that it was the the stimulus in March that was sort of over. We didn't really need all that stimulus, and that there was talk even then that would be a mistake and it would lead to higher inflation, and perhaps that you didn't push back as much as you might have otherwise.
I didn't push back at all, and the reason I didn't, and there was lots of talk about that, but not from the Fed, because that is not our job. We are not the CBO, and we're not elected by anybody. So we take fiscal policy as it arrives at our front door, and we don't comment. We make our own assessments inside the Fed, but it's really not our role. And I think very important that we stay out of that business, no matter who's in the White House, who's in Congress. It's just not our job, and it's something we avoid pretty assiduously.
Thank you.
Thank you.
Thank you, Mr. Chair. Thank you, everyone.
All right. Well, the event has ended. Let's get let's chat. Whoa, hey. Let me pause this real quick. Hey. There we go. Boom. Back to this. Okay. So, hold on a second. Let me switch around my tiki-taki. Let me do my tiki-taki. Flip camera. All right. So, let's talk about it, right? The whole market pumped. Well, I can tell you simply why a big part of the reason why the market pumped, without even getting into the technicals of what he just talked about. The market pumped because he said that that the bond tapering has not started yet. So ultimately, that is good for crypto, right? When he mentioned crypto, acting as if he wasn't, it's nothing, nothing to be concerned about, besides the fact that it is, risky, whatever. That's good. He didn't speak down or ill about it. Here's what I see. I see some of the positions and the way that they are framing a lot of the fiscal policy, and setting themselves up to be. It used to be, look at crypto, it's bad, it's for criminals, and it's starting to change. Why? Because banks want to get involved. The banks know they can't stop the moving train, and so what are they going to do? Well, they want to figure out how can they make money, right? How can they make money off of the crypto markets? Well, there's a number of different options. They can custody crypto, which they're going to want to do, right? They can take control of and basically, what's the word I'm looking for? Basically govern the heck out of stable coins, because that's the biggest threat to bond yields is stable coins, and they know it. So that's what they're really after. They basically needed time to get themselves in a position to be able to earn income off of the crypto markets, right? That's a fact. That's happening. Okay. There's no question about whether that's happening or not. It is. When you have somebody like Jamie Dimon out here talking about how, it's the worst thing in the world. If he catches any of his employees buying Bitcoin, he'd fire them, this, that, and the third. And then that weekend, he makes the biggest purchase of Bitcoin ever by a financial, by a bank. What? And did it privately? Get the heck out of here, right? So, at any event, I have not looked at the market. Let me see here. Let me do a little screen share action here. Thank you guys hey, listen, if you are in here and you guys have not smashed the like yet, do that for me, please. Also, if you're not subscribed, make sure you subscribe. Literally, we're giving away $500 December 23rd. All you got to do is be subscribed. Let's check out the market real quick, okay? Okay, dokie. So let's see here. Boom. Let me. Boom. up 5% right now, right? We got Bitcoin at 49,170, that approaching 50. That's huge. ETH 4,052. We're up at 4,056 right now. ETH is up back over 4K. Binance Coin up 5%. Solana up 14%. Cardano up 5%. XRP up almost 4%. Polkadot almost 10%. AVAX up 30%. My AVAX just pumped, baby. I don't even have very much AVAX, but it's still fun to have it pump, right? Guys, ultimately what we need now this could have been, and this is totally what I'm kind of thinking. This could have been the catalyst saying, hey, listen, we are going to push this off until at least March. And I think what's happening is a lot of the crypto market is saying, okay, if you're gonna push this off until March, if you're gonna push off the tapering until March, we have from now until March for a bull run, baby. For maybe this parabolic blow off top, right? I don't know. I'm just throwing out there that I think the speculation and what's happening is, okay, they didn't just raise rates. They didn't just talk trash about crypto. They didn't do what they could have done and negatively impacted the market. And I think the market reacted appropriately. The market said, okay, we've got some room to run. Now let's get to it. So we have been so bearish, so bearish. Guess what? It seems like every time the fear and greed index this morning, someone in our Debate Crypto Academy, shout out Heidi. I think Heidi shared it this morning. I think Heidi shared the fear and greed index, and I think it was like 18, right? People are fearful, right? And what did we say? So it's debatecrypto.academy. If you guys are looking for to jump in and get involved, that's just absolutely the place to be. We educate so that you guys can help set up a game plan, right? That's what it is all about. We have a Telegram. We have actually 2 Telegram. One's a channel, one's a chat. And we do seminars every single week, private seminars with myself and BlockchainCrusader, Miguel. But what I was getting at was, what did we say to that this morning? When that fear and greed index was posted, Miguel said, that's the good news. And you're like, wait a minute, why is that the good news? Well, the good news is when the entire market is fearful, just like we always talk about, you need to be buying the red candles, selling the green, right? I think we literally maybe just got the news that we needed to press ourselves forward. Crypto fam, check it out. I appreciate every single one of you being here. Again, if you're not subscribed, make sure you subscribe. X out of the live chat, smash the likes. I hope this has been beneficial for every single one of you. This is good for the crypto market. Let's hope we can continue on with a pump. Crypto fam, I love you. If nobody's told you that before today, I love you. Miguel loves you. Crypto fam, Debate Crypto loves you. So we hope you guys have a wonderfully blessed day, and we will talk to you soon. It is Wednesday, so tonight, if you're in here right now, we have What If Wednesday tonight. So what if, right, this was the catalyst that we needed to press ourselves forward? What If Wednesday tonight, 9 p.m., guys. Until next